Hello and welcome. You're watching News Now with me, Anjali Pallod and Ankur Mishra. Yesterday, the Reserve Bank of India came out with the minutes of the Monetary Policy Committee meeting that was held earlier in the month. Ankur, what were the key things that came out in that minutes?
Yes, of course. In the August meeting, you would have noticed that all the 6 members voted for a pause, but the devil lies in details we discussed. So, in that minutes, 3 of the members at least said that there was a room for a rate cut. Although everyone voted for a rate cut, the RBI's MPC, chaired by Sanjay Malhotra, had opted to maintain the repo rate at 5.5%. This decision marked a pause after 3 consecutive rate cuts earlier this year, totaling 100 basis points, with the latest being a significant 50 basis point reduction that happened in previous policy, that is in June, bringing the rate down from 6% to 5.5%. The committee's stance has shifted back to neutral from accommodative, and in the latest policy there was no surprise, and that signaled a cautious approach amid global economic uncertainties, particularly due to trade tensions and tariff wars. But the bigger question is, are we reading too much between the lines? To decode the MPC minutes, we have with us Ashima Goyal, who is a former member of MPC. And apart from that, we also have Sameer Narang, Head of Economics Research at ICICI Bank. Mr. Narang and Ashima Goyal, welcome to this special discussion. Ashima, I want to come to you first. The intention for cutting the rates were there in this meeting. Is it a safe assumption to draw from the minutes of meeting which are released?
Yes, they recognize that there is space and that it may be required to support growth. But in view of uncertainties, they chose to wait and keep space for future action. So I think markets should note that they seems to have internalized a shift to neutral as suggesting that a cut is very difficult, that it's unlikely to happen, etc. And we've seen the 10-year GSEC yields rise as a consequence, the bottoming out. But these minutes suggest that this is just a pause to watch for some time uncertainties and pass through. The members recognize that there is room for action, and action may be required, and future action will be data-based. And just after the last monetary policy meetings, we have seen that 25% penalty tariff, and which increases growth risks and uncertainties. So it may be that the room will be required. It will be required that they use the room available. My own view is that it's better to use space when there are risks on the horizon rather than keep it. Because I think our MPC showed that when you responded to external shocks by stimulating domestic demand, then we were able to sustain growth despite shocks. And that is what we need to do now.
Right. Thanks, Ashima. Sameer, I'd like to come to you. In the MPC meetings before this, inflation was a key parameter that was looked at while deciding on whether a rate cut is warranted or not. Now that inflation has been consistently cooling off, in the future couple of MPCs, what do you think will be the key parameters for them to watch out for?
No, it's a very good question. Actually, if you see the MPCs or the RBI's forecast, it's already been revised lower to 3.1% for the year. We are at 2.8%. And with the recent GST rejig, ideally it comes down a little bit more because a few core goods which have weight of around 8%, thereabouts, should see further downward revision in prices, which should last this year and next year. So on the inflation front, there is some positive news. But most of this news is concentrated in the very short term or near term because of a very high base effect. And the impact of the GST also will be a one-time impact which pushes it down, and then it stabilizes around that level. So the key parameter to look forward is growth rather than inflation, because inflation, as we see, in the near term is not a challenge at all. It remains in that 2 to 3% handle. The other issue is that inflation from March quarter or December onwards starts going up to around 4.5% band, depending on how the GST rates settle, and then closer to 5% in Q1 of next year. So it's the forward-looking inflation which is a bit of a challenge rather than the near-term inflation, and that brings the average down. Given that backdrop, it is growth which will determine the scope for a future rate cut. And there we feel that on the growth front, the recent Q1 data which will be released this month should be fairly robust. It should be in excess of 6.5%. It's the growth in H2 which will be a challenge, as Ashima spoke about, because of the tariffs. But to countervail the impact of the tariffs, the government has also announced a GST rationalization, which in our opinion adds to around 0.3 to 0.4% directly to GDP, and because of its positive rub-off, because of lower prices, that should also open up room for further spending and have its own multiplier impact. So overall, we believe the external headwinds are going to be countered more by fiscal policy than by monetary policy. So as of now, we believe status quo is what is likely to happen in the next few policies.
All right, so that is the expectation coming in from Mr. Narang. Ashima, I want to come to you to understand again inflation more, because of these GST announcements, and the expectation is that if at all in September the final approval comes for two-slab GST structure, what will be the impact of on inflation? Of course, growth we may see slightly picking up as explained by Sameer as well. Do you think it will have impact on inflation as well?
Yes, it will definitely reduce inflation somewhat. And although it is a one-time effect, it will last, until for the next 12 months, it will affect the inflation rate. And while I agree with Sameer that inflation is expected to rise next year, but, as the MPC minutes remark, this is the inflation softening is due to volatile headline one-time effects or transient effects. And because of this, because inflation is at 2% today, it will be at 4.9 in June next year. But that is a base effect again, and it is a one-time, it's a point estimate. So we need to look at average, or what is the core inflation like? And here I think GST is going to reduce core inflation. There was a concern that core inflation is going above 4%, but this is going to come down, and there are base effects of gold price increase, which will also come off. And inflation over the long term, if you look at causal determinants, the core inflation is more persistent, headline is volatile, and headline approaches core. So therefore, it is better to take 4% as your expected forward inflation, in which case there is room for a rate cut. And historically, we have seen through the 2010s, whenever the real policy rate went above 2%, growth slowed. So the real rate is very important. That is what affects consumption, investment, savings, decisions. Yes. And therefore, when people say savings are under threat because of 100 BPS cut, but this is a nominal rate cut. Real rates are much above 2%. And therefore, we have to look through the nominal rate. The nominal rate is important for banks, but even banks gain deposits, savings rise when growth is higher, right? So MPC needs to look at the real rates. And I'm a little disappointed that these minutes do not mention real rates at all. There is an argument that in terms of forward-looking inflation, real rates are low if inflation is going to rise to almost 5%. But as I said, that is a base effect. And since core inflation is going to come down, it's better to take 4% as your expected future inflation, when even in terms of forward-looking inflation, real rates are high today. And they have been high for more than a year now. And therefore, there is a need for correction to bring them at least to neutral when there are growth threats.
Right. So, Ashima, largely it means that with the GST cuts, the core inflation is where the impact will come in, and that is what we'll have to monitor and go by going forward. But Sameer, coming back to you, I want to talk about growth. With the 100 basis point cut that has come in, what are you picturing in terms of growth for the year ahead or even for the next year?
Very, very good question again. So if you see the cumulative stimulus given by the GST cuts, by monetary policy, and by the first fiscal policy stimulus which was given in the budget in the form of income tax cuts, when you aggregate all of these, that will correspond to in excess of 1% of GDP, around 1.2 to 1.3. And on top of that, you have these 50% tariffs or perhaps a global external demand slowdown, which would perhaps take off around 70, 80 basis points, or maybe lower than that, because in case of China, where tariffs have been very high, we've seen that manufactured exports have sustained apart from the exports moving to the US. To other geographies, exports have done pretty well actually. Because these are set supply chains, competitive advantages, it's very difficult to reroute or find another producer in a very short span of time. So what we should see is that perhaps the impact will be there, largely concentrated in the MSME space, which will see a demand reduction, particularly from the US market. But it is possible that for some of them or the producers which are slightly larger are able to meet this via other countries where exports can be rerouted. So overall, in aggregate basis, we believe that growth for the year looks around 6.3. Growth in H1 will be slightly higher, and that is because of front loading by the government. Rural demand is fairly good. There are signs of some pickup in urban demand lately in the FMCG sales data which was reported. So on balance, what you are seeing is domestic economy led by rural, led by excellent growth in terms of construction. Even the core sector data that came out showed that steel demand or steel production went up by almost 13% last month, though the overall number was not that good. So there are parts of the economy which are actually firing. And with the GST cut, we believe you will have a very good festival season, particularly for cars and two-wheelers, where prices should ideally come off materially. So in a nutshell, growth in H1 is looking very good because of front loading of government spending. Capacity utilization for a change has moved to around 78%, which is fairly a higher point we have seen over the last couple of years, almost a decade. So there are signs that the economy is not doing that bad. Yes, external headwinds, I agree with Ashima, is a problem, but the domestic economy, I think, is strong enough, and given the monetary and fiscal stimulus, it's large enough to withstand the impact and actually nullify and make sure that growth is around the MPC estimate of 6.5%. We are marginally lower at 6.3. But we could see a surprise in H1, which is on the positive side.
Surprises are always welcome if you talk about India's GDP growth. But one last question to both of you before we let you go. Do you expect in next policy there will be a rate cut, or there is an expectation or anticipation of rate cuts in later this year? Ashima, I want to come to you first.
Yeah, before that, just a small thing on growth. Even if growth is at 6.5, it's below our potential. And we have these Viksit Bharat vision and employment, etc. So if there is space, I say potential growth is defined by low inflation. If inflation is low, we have space to increase demand, non-inflationary demand and non-inflationary growth, right? So we need to use it. So in view of this position, I think that there is space for a cut and they should do it. Whether they will do it or not is another question. And that depends on how the data evolves. If we see growth being threatened, right? And we see a sharp fall in inflation, further fall in inflation. They're mandated to keep inflation above 2%. And it's at the lower margin. Then they have to stimulate the economy to get inflation up. Yeah.
Right.
Thank you.
Right, Ashima. And what are your views, Sameer, on this quickly as we wrap our show? Before that, I want to get your view first.
No, I think we see a pause in the next few policies unless and until growth really disappoints. And our view is that the data in August will show growth is in excess of 6.5%. The next data, which will come around end November, there also perhaps Q2 growth on a low base which was 5.6% last year, would ideally show a relatively high growth. So, coupled with these factors and a very good festival season because of the GST cut, we don't see incoming data, domestic data at least, showing any large slowdown. So MPC would perhaps, which is data dependent, would probably look at staying on pause for some time.
All right, thank you so much, Ashima as well as Sameer, for joining at this hour and explaining the rationale and the MPC minutes, how it should be interpreted. But for now, we have to wait till October 1 when the final policy outcome will be there from MPC, at least when the next meeting is there. But for now, MPC has given intent. We need to wait and see if it turns into reality. With this, it's time to take a very quick break. After the break, a lot coming on the other side.